Vitrio Financial is proud to support Improving Alpha, Innovation in Investing, ESG and Technology with Michael Oliver Weinberg. Vitrio helps allocators harness investment complexity to make better allocation decisions. Learn more at vitrio.com. That's VIDRIO.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Jose Eduardo Siman will join us. His background and accomplishments are impressive, and he will touch on that shortly. So listeners have a high-level sense of our roadmap for today. This episode will be about innovation in family office investing. We will start with some background color, then discuss how companies, managers, and asset owners may apply his thoughts to investing, and finish with some advice, though I know Jose doesn't love giving advice, but maybe we can get some out of him. Investors and business leaders should be able to extract a great deal of value from Jose's insight. On that note, welcome, Jose.
Thank you very much.
My pleasure. Thanks for joining us. So let's start briefly with your background, particularly how you came to work in your family business, because I know it's sort of a funny story.
Yes, I had the privilege of being born into a family business, very entrepreneurial, all the way from the beginning. And I graduated. It's also a family that put a lot of emphasis on education. And I got my MBA from Columbia in 1969, which was not something that was very common at that time. And I worked for multinationals for about 9 years. And then my dad fell ill, and he asked me to, come back to the business. I wasn't too enthused about that, but that he made me an offer. I said, if you come for 2 years, if you don't like it, you go back and, I won't ask you anymore. So I thought, well, it's not a bad idea. So I did join the business and loved it all, as soon as I came in. To do a story short, about 2015, I was elected chairman. Elected because the shareholders hold elections for the chairman of the group. And I was elected chairman in 2015, which has been probably my biggest honor and privilege.
Nice. And yeah, I couldn't agree more. Though MBAs are quite prevalent today, and like yourself, I'm of course also a CBS alumnus. In 1969, you were a bit avant-garde then. You were ahead of the curve. The MBA was not then what it is today. So, and then in terms of the business today, if we take a look at it, what's it comprised of? Maybe if you could just touch on a few of the more well-known brands and what countries you're in. I think you've expanded it as well, if you like to talk about that international expansion over time.
Yeah, we've grown significantly. We're now in 26 countries in the U.S., Caribbean, Central America, and some of South American countries. We have I would say 4 large divisions. One is specialty stores that sell appliances and electronics and furniture. And that's the one that's mostly in the 25, 26 countries. We have another division that's manufactures apparel for sale in the U.S., exclusively in the U.S. The brand that is most known is Gerber Children's Wear. It's for babies, baby wear. That's our brands. But we manufacture under a lot of licenses of common brands. The U.S. is our biggest market, and followed by Central America, and then some of the Caribbean and the South American countries.
And you started in El Salvador, if I'm not mistaken.
Yeah, I was born my dad is from El Salvador. My mom is actually from New York. So I'm sort of a mixed. And I was born in El Salvador, but because of my mom, I was able to eventually immigrate into the U.S. After El Salvador had a civil war in the 70s. So I've been here from 1982 on.
Got it. And how do you spend your time in the business now?
Well, I'm the chair of the holding company. By design, we don't have a CEO. My authority comes from being the chair of the board. So basically, I concentrate a lot of my time at governance and implementing the decisions that we take at the board level. A lot of I have a team under me that gathers all the information, the vital information on all the companies, and we put together a monthly report for the board. We meet as a board every 3 months, although now with video, we have more frequent meetings when it's necessary. But the formal board meetings are every 3 months.
Got it.
In between, it's mostly implementing the initiatives of the board.
And you mentioned you made a point, I think, of mentioning you don't have a CEO, but you're the chairman and effectively leading the board and therefore setting the direction for the company. Why don't you have a CEO? Obviously, that's by design.
Yes. The holding company, actually, we had a family meeting in 2003, and we had an advisor that helped us guide us on that. And we sort of came together and decided that we wanted a model that was very decentralized because we have businesses in very different areas. And we thought that one CEO would not be able to really do a good job because of how widespread in terms of countries and also of industry. Like we're in retailing. Our original business is a department store in Central America under the same Siman name. So that's one. We also have the franchise of Intradeco, a Spanish retailer for Central America. And then we have real estate. So what we did is we created a model that was decentralized. There's a holding company, but there's also each of the companies has its own board and it has its own CEO. And I think the model has worked very well because that decentralization has allowed each subsidiary to grow and have a lot of room without bureaucracy, et cetera, et cetera. But that was the original intention. We thought that having a CEO at the holding company level would actually clash with the CEOs and chairmen of the subsidiary boards.
So as we're both CBS or Columbia Business School, it sounds actually a lot like Warren Buffett's structure at Berkshire.
Yeah, we license Fruit of the Loom products, so I'm familiar with them. We have a big difference with them. I wish we could go to that model because we're decentralized, but the holding company does not control the cash, which Warren Buffett does. And by controlling the cash, that allows him to reallocate capital to those areas of the business that are actually giving you the highest performance and creation of value. We can't do that. Each subsidiary has its own capital and its own cash structures. And then sometimes when I felt that we're not getting the highest creation of value with the capital allocation that we have. But we've managed to, over time, be able to reallocate capital, but it's a difficult thing to do under the present model. And that's how we differ a lot with the Berkshire Hathaway model.
Got it. Interesting. Very interesting. Well, maybe that's something you can work on in the next phase of your career.
I think so. Well, it won't be me. I'm retiring on the 1st of September. I'm aged out. But we are in the middle of a generational transition from the third generation to the fourth. And I think the fourth generation is really going to move our model more to an asset management model, where the holding company is going to control cash, and that will allow it to be a lot more flexible with capital allocation.
That sounds like it would be a sensible move based on what you've said and in terms of the success that Berkshire has had with that model. And how is the business innovating to improve returns?
Well, like if you don't innovate, you die. So we've always been very keen on having our businesses as innovative and as efficient as possible. We reinvest 70% of our profits, and that is because of the family's view that the family's shareholdings or patrimony is for the long term. It's to be passed from one generation to another with a good social responsibility. We have 5% of our profits are channeled into social responsibility projects. So that view of the family that long-term view allows us to reinvest, and by reinvesting, we're continuously, reinvesting to bring our companies to the forefront of whatever they're doing. For example, the retailing companies have the latest software. They have the latest, points of sale models, and they've done a lot, especially with the pandemic, a lot of online sales structure. So all of those are examples of reinvestment that allows you to be at the forefront of the business, but also to grow.
And obviously this podcast is about what we call improving alpha, innovation and investing, ESG and technology. On the ESG front, are there other angles, or is it primarily the 5% redeployment to ESG?
No, actually, we're very proud of an initiative on our textile mills. So from some time ago, we were using recycled polyester from water bottles, polyester bottles. That was transformed into polyester yarn. But lately, in the last 2 years, we started an operation that actually recycles cotton. In other words, from the cutting of the garments, we recycle the pieces and bring them back to basically a bale of cotton. And now we're able to produce 100% recycled textiles with cotton and polyester mix. That's very few companies in the world are actually able to do that. And it's a part of our businesses that's growing significantly because there's now people are putting attention to the fact that there's a lot of clothing that goes to waste. I mean, somebody was telling me the other day that I think it was H&M or one of these brands, that a reporter followed their supply chain and found that part of a number of those products that had not been sold ended up in a dump in Africa or something like that. And the CEO of the company couldn't believe it, but actually it happened. So a lot of focus now is on recycling even new products or used products. And that's part of our business that we put a lot of emphasis on, but we're going to be growing a lot because we've been able to dominate the technology to be able to do 100% recycled products.
That's great. Yeah. And that does sound like it's definitely the wave of the future in terms of apparel manufacturing. And to your point, yeah, I mean, having spent a fair amount of time on ESG in my career over the past however many years, yeah, I mean, the apparel industry is arguably a huge issue from an ESG perspective, particularly fast fashion. And so the more you can recycle and, to your point, avoid apparel being effectively dumped, unworn or unused or unsold, that's a no-brainer. Yeah.
What surprised me also of this product is, I thought, okay, it's recycled product. I didn't think it was going to be that great. But when I saw the textiles, they're really very, very, very good. I mean, they don't have anything
indistinguishable. Sorry.
Sometimes I think they're even better.
Got it.
So that was a big surprise to me. The other thing that happens is that you're recycling already dyed pieces of cloth. So when you manufacture these textiles, you don't have to dye. And the dyeing process, as you know, is a big polluter. So you're avoiding doing that. You're avoiding polluting in manufacturing those garments.
That's great. Yeah. I mean, to me, and I'm sure you don't disagree. That's like the proverbial free lunch, right? You've effectively turned waste product into what can be a finished good, and you've avoided filling landfills, and you've also avoided the sanitation cost of eliminating the waste.
Yeah.
So it seems like largely a no-brainer. Yeah. Well, that's great. Anything else you wanted to touch on from a technological innovation, or sort of aside from, clearly there's some technology involved in that, and then you mentioned the cutting edge software, but anything else from a technological point worth mentioning? Or
I think from the difficulty of technology, the project of recycling the cotton is probably the most difficult ones that I've seen in our group. Everything else is adopting already existing technology and making sure that your companies are at the forefront of what they're doing.
Right. Makes sense. All right. Well, let's move on. Where do you see the most interesting or best opportunity from an investment perspective now?
In terms of our businesses, we're going a lot into finance. Diversify from retailing into finance. Especially in Latin America, where there's a lot of people that are unbanked, and the cell phone technology allows you to actually do a lot of banking processes through the phone, through an app on the phone, and that's something that we're getting into. For example, we developed a software or an app for phones, where the customer can actually get a credit approval through the phone, or can order products and get a credit approval at the same time through an app on their phone. So we're moving a lot into doing everything online.
That's great. Yeah, and irrefutably, that's the wave of the future, particularly for the unbanked. I mean, phone penetration is obviously immense and continues to grow. So that makes a lot of sense.
Not only that, but I'm sorry to interrupt you, but
no, that's fine. Please.
What's interesting is the younger generations even in Central America and the Caribbean, they're very adept at using their phones.
Yeah, you were going to say iPhone, but or any phone.
Whatever. Samsung, Android or
doesn't matter,
or Apple phones, and they're very adept at adapting, of using these apps. So that gives you an opportunity to grow with that younger crowd.
Yeah, absolutely. I mean, my daughters have been using the app since they were in their low single digits. I mean, it's quite remarkable. Yeah. And then what's the biggest challenge to achieving your goals or the company's goals?
We're in the middle of a generational transition, and not only are the owners moving from one generation to the other, but also up to now we've been a family managed business, and the management team that grew the companies in the last 40 years is now at the age where we're retiring and have to hand over to the newer generation. Those that succeed us are not necessarily going to be family members. We need to get the most capable people, but that succession process is a challenge we're going through at the moment. It's not easy when you have a big company to make that transition. So I would think that's the biggest challenge at the moment, and it's also for the family also to understand that this is a meritocracy, and it's a professionally managed business, and they shouldn't really get involved. If you fire a family member, we have to fire family members, that they don't make a big fuss about it. As owners, as family members, it's difficult for them to separate themselves from the businesses, but they have to do that.
And simultaneously, a canonical Columbia Business School debate is principal agency conflict. How do you deal with that in terms of presumably the family owns the vast majority, if not the entire business, and if you're hiring non-family members, they're agents by definition, and how do you keep them aligned, I guess, would be maybe a nicer or better way to ask the question.
Well, I think that, like I said, we're at the moment, we're still a family run group, but we're moving to a point where, as the successors are going to be professionals, you're separating ownership from management.
Right.
And that's where you have to really make sure that the owners have the right to a certain, to information, to make sure the companies are well run, that the debt levels don't get out of hand, et cetera. But they also shouldn't be getting involved other than through the governance structures in the running of the businesses. So you have to keep that separation. And that's a daily situation. That's a daily task.
Right. And not to belabor it, but I guess my question is along the lines of that transition, how do you believe you'll be able to align the incentives of the third-party management, the non-family members? Do you is that something you've thought through yet or worked, in terms of alignment of interests so that theirs are aligned with yours?
Well, the way we do it is by running compensation based on the creation value. That your medium and long-term compensation is based on the value you created in that business, and that aligns the benefit to the management with the benefit to the owner.
What's a red flag when you're either looking to invest in a business or buy a business? Something that sort of scares you or makes you think twice?
I mean, we do, when we buy a company, we do a lot of due diligence. But I also put a lot of emphasis on the character of the owners that we're buying from. I've had, for example, a couple of situations where we bought companies where the owners are people of high integrity, that they run the businesses very clean. And what we've taken over, because many times, if you're buying a well-run business, you're probably paying a lot of goodwill for that. But what we find is on the other place where we buy it, those businesses are very solid, and we don't get any surprises. On the other hand, we've had a couple of situations where we bought businesses from people who were, frauds or cheating, and we ended up, paying for something that wasn't what was supposed to be, even though we used Big Four accounting firms to do the due diligence and to do all of the studies and everything. But still, we bought something that wasn't what it was supposed to be.
Yeah,
so the character of the owner is a big thing, including, but that's assuming that you also have to do a lot of due diligence when you're buying the business.
Yeah, well, that segues into a question I was going to ask you subsequently anyway, which is what any lessons from that? Anything that I understand, you've used top Big Four firms, you've done good due diligence. Look, if someone's willing to commit fraud and willing to go to jail or, be fraudulent, it's very hard often to know but what lessons were there from that, if any, or anything that you've subsequently learned to prevent future situations?
We went back on that situation to study what did we do wrong. And the CEO of the company that bought it is our most successful CEO, a very responsible person. We ended up seeing that we did everything that we had to do. We did the due diligence. We had good advisors. In fact, I told the CEO he was so upset about it that I had to tell him, look, you have to calm down, because if you have a heart attack, I'm going to have a much bigger problem than losing, the X million dollars we're going to lose from this purchase. But what you said is true. I mean, if somebody wants to commit fraud,
yeah, it's hard.
They'll find a way. It also was in a country where the guy was very, very involved with the government, so he was able to fudge numbers of the government information that you don't get in other countries.
Got it. And that's a good segue to inflation in Central America. Inflation is not something new to Central America, right? But yet to the Western developed world, the U.S., Europe, it's been in latent for decades now, since the 80s, really. How do you deal with it historically?
Well, Central America and the Caribbean don't have the levels of inflation that South America, some of the South American countries like Bolivia or Venezuela or Argentina had. They've been manageable, more higher than the U.S.,
right?
But still manageable. Well, we do a number of things. Like, for example, in many of we have a large consumer credit portfolio. And what we do is we borrow from local banks in local currency what we have in the consumer credit and inventory. So that if you have a devaluation or if you have inflation, both devalue at the same time, the asset and the liability, and your capital is somewhat protected. In terms of the inflation per se, they haven't been levels that are, like I said before, like Argentina, Bolivia, or Venezuela. So we've been able to manage it. The problem is all of those economies and all of those have a very, very low per capita income, so that any increase in prices hits the ability of the consumer to buy. So your sales might be the same or a little bit higher in dollars, but your units go down because people just can't buy the same amount of units when the price is going up. Interesting.
Makes sense. On a more fun topic, do you have a favorite book or one you've read recently?
Well, that's a difficult question. I don't think I have a favorite book, but the one that comes to mind, one that really made an impact on me, that I read about 10 years ago, was from a British philosopher, Jonathan Glover, and it's called Humanity, the Moral History of the 20th Century. What he did is he studied all of the genocides and the Holocaust and things like that in the 20th century, and he tried to extract common lessons from them. And he found that when people start objectivizing another person or another nationality or another type of religion or whatever, and you start losing seeing the humanity in that other person, anything can happen. And he was talking about the first thing that leads you in that path is name calling. So that really made me understand that even when somebody, when you say that another nationality, like what Trump said, Mexicans are rapists, maybe when you hear it, you don't give it much importance, but that's the first step in dehumanizing a nationality or a people's or religion. And if you continue on that path, you can end up in a genocide or you can end up in the Holocaust. So that book really made an impact on me. Other than that, I read many, many, many books, but I really can't pick one or the other.
I can see why that resonated with you, and it's been poignant for you for a decade. And I couldn't agree more with the premise. And I think that it sounds as though the author and the book are spot on. And it sounds like we should all read that. I certainly haven't, but yeah. Well, I know you don't like giving advice, but nonetheless, it would be remiss of me not to ask you for it. So, or maybe not advice, but any words of wisdom you have for investors navigating this landscape, either in manufacturing, retail, apparel, or otherwise.
Yeah, like I said, jokingly, we don't give advice. I can only tell you what our experience is. I think you have to be very objective especially when you're buying businesses or investing in new businesses. Very objective about the pros and cons, looking at all of the options and assigning probabilities to each option, so that you take into account the best that can happen, but also the worst that you can happen, and protect yourself against, if the worst happens, what can you do to protect yourself against that? And that could avoid you going bankrupt if you go into too much debt or making big mistakes. I think that the defining of all of the different options and being open to look at everything, because many times when you're looking at buying or a new project, you tend to be very optimistic and only think of the good scenarios. But I think you have to discipline yourself to see all of the scenarios, including worst case scenarios, so that you can protect yourself against that happening if it happens.
I couldn't agree more, having been an investor for the last 30 years at both the security level and investing with managers. And if I think of many of the best ones, they do exactly that. They look at probability weightings. They look at different scenarios. They look at their worst case. They don't necessarily invest if the probability is too high of a worst case scenario that could lead to a massively adverse outcome. So I think that's great advice for anyone at any level. Anything we didn't discuss that you'd like to share with our listeners?
Not that I can think of off the cuff at the moment.
Okay. Well, look, Jose, we'd like to thank you for the super interesting discussion, sharing your most valuable asset with us, your time. We hope listeners have a better appreciation how one of, I guess I'll say our hemisphere's more thoughtful business leaders is thinking about managing and running a substantial business. And this is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we'll speak with another thought leader who'll provide insight into improving alpha via innovation. Until then, stay well, and thank you, Jose.
Thank you for listening to Improving Alpha, Innovation in Investing, ESG and Technology, sponsored by Vidrio Financial. With Vidrio Financial, asset managers, endowments and foundations, pensions, family offices, insurance plans and sovereign wealth funds can cut through the complexity of asset allocation to reduce costs, mitigate portfolio risk, optimize compliance controls, and improve performance analytics. Interested to learn more? Contact us today at vidrio.com. That's vidrio.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.